Hey everyone, and welcome back. Today, we're bringing you another explainer, where we're going to take a bit of a step back and look at the absolute core foundation of modern business. We talk about company valuations and market trends all the time, right? But today, we're really getting under the hood to look at the exact architectural blueprint of financial reporting. Let's dive right in. Remember being in school? At the end of every semester, you'd get a report card that proved exactly how you performed. Well, companies do the exact same thing. But instead of academic grades, they use financial statements. It's how they objectively prove how efficiently they're deploying capital and managing their money. It is, quite literally, the report card of a business.
So, what are these things actually? At their very core, financial statements are simply reports. They take all the complex, messy, day-to-day financial activities of a company and summarize them into a neat, readable package. And this summary is absolutely essential. It helps everyone, from the people inside the business to outside investors, all the way up to government regulators, understand exactly how well that company is doing. It's the ultimate blueprint of business analysis.
Okay, so to read this blueprint, we'll be examining 4 key areas today. 1, the balance sheet. 2, the income statement. 3, the cash flow statement. And finally, number 4, why they matter to the broader market.
Let's kick things off with our very first major pillar on the agenda, the balance sheet, which gives us a snapshot of financial health.
The best way to think about the balance sheet is to imagine it as a financial selfie. It literally freezes a specific moment in time. It doesn't show you what happened over a whole year. Instead, it captures a company's exact financial position, locked in at a single specific date. It's just a frozen snapshot of where they stand right in that moment.
And that snapshot is built entirely on what we call the fundamental accounting equation, which is broken down into 3 really distinct categories. First up, you have assets. That's what the company owns, like cash in the bank, buildings, or inventory. Second, liabilities. This is what the company owes, including bank loans and unpaid bills. And finally, equity, which is the true value left over for the owners after all those debts are cleared out. So basically, assets equal liabilities plus equity.
Let's put some real numbers to this to see how it plays out in the real world. Say a company has $500,000 in assets. Sounds great, right? But wait, they also have $200,000 in liabilities or debts. If we do the simple math and subtract what they owe from what they own, their equity is $300,000. This calculation is a real game changer. By just looking at these numbers, investors can immediately determine a company's leverage. They can see if the business is standing on a solid foundation of owned assets or if they're, just teetering on a mountain of debt. All right, moving right along to section 2, the income statement, which is often called the performance movie.
So if the balance sheet is a frozen selfie, the income statement, which you might also hear called the profit and loss statement, or P&L, well, that's a movie. It shows whether a business is making or losing money over a specific period of time, like a quarter or a full year. And the absolute star of this movie? That's net income. The formula here is beautifully simple. You take your revenue, which is the total money earned from sales, and subtract your expenses. Actually, to be precise, that means all the costs of running the business, like rent, salaries, materials, and that equals your net income. It's the final profit remaining after everything is paid for.
To put that into perspective, let's look at a $1 million example of this profitability in action. Imagine the company earns an impressive $1 million in revenue. Huge milestone. But they had to burn through $700,000 just on operating expenses to get there. Subtracting those expenses lands us on our final net income of $300,000. This right here is the crucial bottom line metric investors look at to separate the truly profitable businesses from the ones that are just, spinning their wheels.
Which brings us to the third pillar on our agenda, the cash flow statement. I personally like to call this one the reality check.
Here is a fundamental, wild reality of business that trips up even seasoned investors. A company can look incredibly profitable on paper, but still go totally bankrupt. How? Well, while the income statement includes non-cash items, the cash flow statement tracks physical, actual dollars. Think about this contrast. A company might show a healthy $500,000 paper profit, but if they just went out and spent $600,000 in physical cash to buy heavy machinery, they're suddenly facing a severe cash shortage. They can be profitable, yet literally unable to pay this month's rent. No way around it. So to monitor this lifeblood, physical cash is divided into 3 distinct buckets. First up, operating activities. That's the cash generated from your day-to-day business, like customer sales or paying suppliers. Second, investing activities. This is cash spent on or earned from assets, like buying that new heavy machinery we just talked about. And third, financing activities. Cash from funding the business, like taking out bank loans, issuing stock, or paying out dividends. Tracking these 3 buckets tells you exactly where every single dollar comes from and where it vanishes to.
Now that we've covered the what and the how, let's transition to the fourth and final section of our agenda to discuss the human element, why they matter, and the stakeholders who actually rely on them. Because listen, these financial statements aren't just accounting busywork. They are the ultimate source of truth for 4 distinct groups of people. Investors rely on them heavily to evaluate cash flow before risking their own capital. Banks and lenders analyze them to stress test whether a company can actually repay a loan. Inside the building, business owners use their own report card to control costs and plan for growth. And at the highest level, regulators depend on these exact statements to enforce tax laws, protect investors, and prevent systemic fraud.
So the absolutely crucial point to take away from all this is that no single statement tells the whole story on its own. It's like a giant puzzle. You have to put them together. Step 1, the balance sheet, proves a company's stability. Step 2, the income statement, proves their profitability. And step 3, the cash flow statement, proves their liquidity and actual survival. By combining these 3 distinct reports, you finally unlock the ultimate, complete snapshot of a company's true financial standing.
And that leads us to a final, really important thought. As we've learned in this explainer today, these documents exist to provide absolute transparency. They protect investors, they guide owners, and they satisfy regulators. So I want to leave you with this question to chew on. If a company's financial report card is hidden, obscured, or just overly complicated, what exactly are they failing to tell you? The next time you look at a business, I challenge you to look just a little closer at their numbers. Thank you so much for joining me for this explainer, and I absolutely can't wait to dive into our next topic with you. Stay curious.